So you've probably heard that an ISA can help you save money. But do you know how they work, what the rules are, or what options are available?
You have my curiosity, but now you have my attention.
Well, if you want to find out, stick around for the rest of this video. Hello and welcome to my channel. My name is Ash. I work at a wealth management firm in London where I'm currently studying to become a financial advisor. My goal is to educate people on personal finance and investing, so I would really appreciate it if you could like this video and subscribe to help me convince YouTube to push out my content to as many people as possible. Although I am training to become a financial advisor, my content does not constitute financial advice. If you do want to be referred to a financial advisor, reach out to me and I will happily refer you. Okay, let's start with the basics. So an ISA, otherwise known as an individual savings account, is basically just a tax wrapper. So what is a tax wrapper? Well, a tax wrapper allows you to shelter your savings against any tax liabilities. When you invest in various types of assets or accounts, your returns come in the form of interest, dividend payments, or capital gains. These are all taxable. The most common types of tax wrappers in the UK are pensions and ISAs. But ISAs come in a number of different types, all with varying features and rules. Some of the most common types of ISAs that you might have heard of are cash ISAs and investment ISAs, otherwise known as stocks and shares ISAs. But there's also the lifetime ISA, the junior ISA, and also the innovative finance ISA. But the one most common thing that is shared between all types of ISAs is the ability to grow your savings without incurring any tax. To open a cash ISA, you need to be over age 16. But to open a stocks and shares ISA, you need to be over the age of 80. If you are under the age of 16, a parent or guardian can open a junior ISA in your name, but these work a little bit differently. As a UK resident over the age of 16, you can contribute up to £20,000 into an ISA or across a number of different types of ISAs in the current tax year. But if you are under the age of 16, the amount you can contribute is capped at £9,000 for the current tax year. At the start of a new tax year, any unused allowance is taken away. So it's beneficial to use as much as possible of the 20k allowance if it's affordable. You can open one of each type of ISA per tax year, but you can still only contribute £20,000 between them, and the lifetime ISA has its own special cap of £4,000. The following year, you either have the option of contributing to your existing ISAs, or you can open new ones of each type. This is more significant for cash ISAs, with fixed terms and guaranteed interest rates which compete with each other. Each year, companies and banks offer differing rates, so it's a good idea to always shop around if you have the opportunity to invest some money. One thing to note is that some ISAs are Flexi ISAs. Now, in a regular ISA that's not a Flexi ISA, you get your £20,000 ISA allowance for the year, and that's that. However, with a Flexi ISA, you can withdraw some of your money and get some of your allowance back in the current tax year. A quick example could be this. Say I already had £20,000 in a non-Flexi ISA. If I haven't contributed anything this tax year, I'd still have £20,000 to contribute from my ISA allowance. Now, if I withdrew £10,000 from my existing account, my ISA allowance for the current tax year would still be capped at £20,000. However, if this was a Flexi ISA and I withdrew the £10,000, my ISA allowance would then increase to £30,000 to take into account the amount that I withdrew. This means that I have until the end of the current tax year to put my money back in without losing my precious tax-free allowance. Okay, so now you understand that an ISA can help you shelter your savings against the potential tax liabilities that you might incur. Now let's do a quick overview of the different types. So the first one is a cash ISA. A cash ISA is the safest type of investment that you can make. The only risk of losing your capital is if the bank or company that you have invested with goes down. And even if that happens, the Financial Services Compensation Scheme would reimburse you with up to £85,000 of your loss. The interest rate you receive is guaranteed, so yes, it is a safe place to put your money. However, interest rates in the current market are pretty low. If you'd like regular access to your savings, you'd struggle to find an interest rate that's better than 1%. And even if you are happy to lock your money away for a set amount of time, the best you'll find is 1.35% per year. So is it worth it? The answer is no. Say you had built up £20,000 of savings over the years and you wanted to put it all into a cash ISA. The highest rate available today of 1.35% would only produce a return of £270 after a whole year. And so there's no real benefit of these savings being in a tax wrapper. And let me explain why. So what would happen if it wasn't in a tax wrapper? Well, in 2016, the government introduced the Personal Savings Allowance, which effectively allows you to earn interest up to £1,000 tax-free if you're a basic rate taxpayer. Therefore, you could have savings of up to £70,000 and still not incur any tax without even investing in a tax wrapper. But this only applies to cash-based savings which provide a guaranteed interest rate. So if you are dead set on investing your money into cash-based savings with no risk, the best shout for you is not to invest in a cash ISA, but to find a savings account and not have to worry about the restrictions of the ISA allowance. But there is a big problem here. What about inflation? Inflation is the general increase in prices over time. As assets such as property, stocks, and everyday items get more expensive, the purchasing power of the money that you have in your bank account actually goes down. The rate of inflation has been averaging around 2% over the last few years. However, anyone that's studied economics at a basic level will know that when governments pump a lot of money into economies to try and spur economic growth, the demand for things increases because everyone's a little bit more liquid, meaning that the price of everything will gradually go up. The result of this is that inflation isn't likely to slow down anytime soon. So if your investments are earning you less than 2% a year, it's likely that the purchasing power or real value of your savings is actually going down each year. This could mean that you put in the right work at the beginning when you're saving the money, but because it's not in the right place, you get to the point where you actually need the money to purchase something or to start a business, and it's not worth as much as you thought. So is there an alternative? The answer is yes, but only if you are willing to wait. By using an investment ISA or a stocks and shares ISA, you have the potential to earn high levels of growth, but your money is at risk. As you've seen over the last few months, markets can be very volatile. So to avoid taking any massive losses when you need the money the most, it's better to invest for an objective in 3 to 5 years. This way you have enough time for markets to recover before needing to pull your money out for whatever you need it for. I'll be going into much more detail on investment ISAs in my next video, so to make sure you don't miss out, don't forget to subscribe and turn on the notifications. If you want to learn more about how I manage my personal investment portfolio, make sure to check out the Wealthy Minds newsletter by heading to my website at wealthymindofash.com. Finally, thank you for watching. If there are any parts of this video that you want me to go into more detail on, please let me know. I would also really appreciate it if you could give this video a like to help push out my content to as many people as possible. And if you would like to see more of my content, please go ahead and subscribe.